Hi, my name is Lauren Hughes, and today I will be talking about double entry accounting for Finance and Accounting 315. Double entry accounting is a system of accounting in which every transaction affects at least two accounts. Double entry accounting is important because it 1. Increases accuracy, 2. Reduces errors, 3. Leaves an audit trail, and 4. Provide an easy way to create a financial statement. Accuracy is when double entry booking provides a more accurate look at a company's financial position than single entry bookkeeping. Recording both revenue and expenses provides an accurate calculation of profits and losses. Profits and losses are represented on the income statement, which includes accounts calculated directly from the entries made in double entry bookkeeping. Error reduction. Human errors can cause a misrepresentation of a company's financial position. Double entry bookkeeping reduces errors because it provides checks and balances. This reduces the chance that a transaction is posted to the wrong offsetting account. Leaves an audit trail in double entry bookkeeping reduces fraud by leaving an audit trail. An audit trail allows you to trace transactions from the journal entries that were posted to the general ledger. And finally, financial statement preparation are easily prepared in companies using double entry bookkeeping because information is gathered directly from the double entry bookkeeping transactions. Financial statements quickly and are done efficiently. Internal users, such as management, depend on financial statements to assess where the company is financially and to create operational budgets. During this presentation about double entry accounting, we will cover subtopics of T accounts, increases and decreases in account, expanding the rules of debit and credit, and normal balances in account. T accounts are a shortened form of the ledger. In the icon listed above, the example where it says cash is what is called the account name. Debit, DR, and credit, CR, according to page 62 of the textbook, are the abbreviations for both appropriate names. T accounts are set up to where the left side is called the debit side and the right is known as the credit. When recording increases and decreases to an account, we must determine the account type, whether it's asset, liability, or equity. For any account, increases are recorded on one side and decreases are recorded on whatever is opposite. Assets are always increased with a debit and decreased with a credit. When it comes to liabilities and equity, are always increased with a credit and decreased with a debit. In expanding the rules of debit and credit, there are 4 different account types in terms of equity. 1. Owner capital, 2. Owner withdrawals, 3. Revenues, and 4. Expenses. Owner capital and revenue increase equity, and owner's withdrawals and expenses decrease equity. In normal balance of an account, a normal balance appears on the increased side of an account. If assets are increased with a debit, the normal balance would be a debit, which is associated on the left. Liabilities and equity increase with a credit would appear on the right. So how exactly does double entry accounting apply in the real world? An entry-level professional uses T accounts, possibly for general knowledge of revenue and expenses. For example, a recreational sports committee might just want to know the numbers of what is being spent. A mid-level professional uses T accounts for general knowledge of revenue and expense plus details of items making up each of these inputs. What that means would be, where are these numbers coming from and what areas are we looking at, like soccer, football, cheer, etc. And at the executive level, T accounts are used for general knowledge of revenue and expenses plus details of items making up each of these points, in addition to depreciation and equity of assets. This person will want to know everything the middleman knows, plus depreciation and equity. For example, when you buy a football helmet for X amount of dollars and you can use it for 5 years, Each year, it depreciates in value, but remains a great asset because you don't have to buy a new helmet. Ethically speaking, in double entry accounting, monitoring the flow of cash in a not for profit business is essential to the longevity and success of said business. Many not for profits disappear each year simply because of their inability to demonstrate where the money was used. An example of this is from a Baptist Foundation of Arizona, where a Baptist minister cooked up a scheme where a non for profit could easily generate the funds it needed in order to build Baptist churches and carry on with the philanthropy that works for Arizona's poor sector. The minister borrowed substantial funds from the ASBC and later convinced estimated 11,000 elderly church members to invest their life savings in retirement funds. In the Bible, Romans 13:8 says, "Let no debt remain outstanding except for the continuing debt to love one another, for whoever loves others has fulfilled the law." This concludes my presentation. I hope you enjoy it and look forward to learning more about finance and accounting. Thank you.